Hello everyone, welcome to Business School 101. Imagine you're a business leader deciding whether to enter a new market abroad, invest in new technology, or choose between expanding in a developed country or exploring an emerging market. These strategic decisions are central to international business. But what exactly are emerging markets? What are their shared features? What strategic challenges might you face, and what real-world examples can guide you? In this video, I will discuss these questions with you. Section 1, Definition. Emerging markets refer to economies that are in the process of rapid growth and industrialization. These markets often exhibit higher levels of volatility and risk compared to developed economies but also present significant opportunities for growth. At their core, these markets are in a transition phase, moving from low-income to middle-income status, and are becoming more influential in the global economic landscape. Section 2, Economic Indicators. Emerging markets typically have a wide range of economic indicators, reflecting their diverse stages of development and income levels. However, here are some general figures and characteristics that can help outline the economic landscape of emerging markets. Number 1. GDP per capita. The GDP per capita in emerging markets generally ranges from about $2,000 to $15,000. For instance, in 2023, countries like India and Vietnam had GDP per capita figures around $2,500 to $4,500, while more advanced emerging markets like Malaysia and Turkey had figures closer to $10,000 to $15,000. Number 2. Average income. The average annual income in emerging markets can vary widely. In lower-income emerging markets, it might be between $1,000 to $5,000, while in upper-middle-income emerging markets, it can range from $10,000 to $20,000. Number 3. Poverty rate. While poverty levels are decreasing in many emerging markets, a significant portion of the population still lives below the poverty line, especially in lower-income countries. The percentage can vary significantly, from around 10% in more advanced emerging markets to over 30% in less developed ones. Number 4. Urbanization rate. Emerging markets are experiencing rapid urbanization, with urban populations often growing faster than in developed economies. The urbanization rate in many of these countries can be around 50% to 70%, depending on the specific country. Number 5. Income inequality. Income inequality is often pronounced in emerging markets, with Gini coefficients typically ranging from 0.35 to 0.55, indicating a relatively high level of income disparity. Section 3 Features. In general, emerging markets normally share the following features. Number 1. Rapid economic growth. Emerging markets often experience faster GDP growth driven by industrialization and urbanization. China is a prime example, having transformed from an agrarian society into the world's second-largest economy. With GDP growth averaging 10% annually over several decades, China's rapid rise highlights the vast economic potential in emerging markets. Number 2. Expanding middle class. The expanding middle class in emerging markets significantly drives economic growth by increasing demand for goods and services. In India, over 300 million people now belong to the middle class, fueling consumption in everything from consumer electronics to automobiles. This rise in purchasing power makes India a lucrative market for both domestic and global businesses. Number 3. Market volatility and risk. Emerging markets often face greater economic and political volatility compared to developed markets. Brazil exemplifies this with its history of economic instability, including fluctuating commodity prices and political upheaval. Despite these risks, Brazil's vast natural resources and large consumer market continue to attract investors looking for high returns. Number 4. Developing infrastructure. Infrastructure development is crucial for supporting economic growth in emerging markets. Indonesia, for instance, is heavily investing in projects like the Trans-Sumatra Toll Road to improve connectivity and reduce logistical costs. These infrastructure improvements are essential for attracting further investment and sustaining Indonesia's economic expansion. Number 5. Attractive for foreign investment. Despite the inherent risks, emerging markets are highly attractive for foreign direct investment. Vietnam has become a manufacturing hub due to its competitive labor costs and favorable government policies. Major global companies like Samsung and Intel have established significant operations in Vietnam, driving the country's rapid economic growth and integration into global supply chains. Number 6. Economic diversification and industrialization. Emerging markets are often in transition from agrarian-based economies to more diversified ones with growing manufacturing and service sectors. Saudi Arabia's Vision 2030 is a clear example of this, as the country invests in tourism, entertainment, and technology to reduce its reliance on oil. Projects like the futuristic city NEOM symbolize Saudi Arabia's commitment to fostering a more diversified and resilient economy. Section 4. Strategic issues. Here are 10 critical issues companies should consider before entering an emerging market. Number 1. Political and economic instability. Emerging markets often grapple with political and economic instability, disrupting business operations and investments. Companies must diversify investments and adapt to the volatile political landscape. For example, Venezuela's hyperinflation and currency collapse forced businesses like Coca-Cola to suspend production, illustrating the risks of operating in unstable markets. Number 2. Regulatory and legal challenges. Regulatory environments in emerging markets can be unpredictable, with unclear laws and corruption posing significant challenges. For example, in 2016, India's sudden demonetization caused widespread disruptions, forcing companies like Apple to quickly adapt by increasing digital payment options. Number 3. Infrastructure deficiencies. Poor infrastructure in emerging markets increases operational costs and logistical challenges. Strategic planning should include infrastructure investments or partnerships. For example, Nigeria's unreliable power supply forces manufacturers to rely on costly diesel generators, reducing competitiveness. Number 4. Cultural differences and consumer behavior. Understanding local culture and consumer behavior is crucial for success in emerging markets. For example, Walmart's failure in Germany, due to cultural misalignment, highlights the importance of adapting to local customs, especially in emerging markets. Number 5. Competition from local players. Local companies in emerging markets often have a strong market advantage. Foreign businesses need to innovate or partner with local firms to compete effectively. For example, in India, Amazon faces stiff competition from Flipkart, which tailors its offerings to local consumers and excels in logistics. Number 6. Talent acquisition and management. Securing skilled talent in emerging markets can be challenging due to education gaps and competition. For example, GE has invested in local training programs in Africa to overcome skill shortages, particularly in sectors like healthcare and energy. Number 7. Supply chain vulnerabilities. Supply chains in emerging markets are prone to disruptions from poor infrastructure and political instability. Businesses should build resilient supply chains. For example, the 2013 Rana Plaza disaster in Bangladesh exposed the risks in global supply chains, prompting a push for better safety standards. Number 8. Currency fluctuations. Currency volatility in emerging markets can impact profitability. Companies should manage risks through hedging or localizing production. For example, the 2018 depreciation of the Turkish lira led to increased costs for companies like Ford, affecting pricing and profitability. Number 9. Corporate social responsibility (CSR) is critical in emerging markets, where businesses must address social and environmental issues to enhance their reputation. For example, Nestlé's response to criticism in Africa over infant formula marketing shows the importance of aligning CSR strategies with local needs. Number 10. Intellectual property protection. IP protection can be weak in emerging markets, posing risks for companies. Businesses should assess the IP landscape and consider joint ventures or licensing. For example, Huawei's legal challenges in the US over IP rights highlight the need for robust strategies to protect intellectual assets in emerging markets. Section 5, Summary. To sum up, emerging markets offer immense opportunities for growth and expansion but also come with unique challenges and risks. Understanding these markets is essential for businesses looking to expand their global presence, diversify their operations, and gain a competitive edge. By developing the right skills and strategies, companies can successfully navigate the complexities of emerging markets and capitalize on their potential. Alright, that's all for today's topic. If you have any questions regarding this video, please leave your thoughts in a comment below. I hope you guys have enjoyed this video, and if you did, make sure you give it a thumbs up and subscribe to my channel. Thanks for watching, and I will see you next time.